Hi looters, welcome back to Tick to Loot market updates for August 17th, 2026. We've got a packed agenda. A quick look at yesterday's moves, today's key data releases, and why China's delayed July numbers matter. First, a quick reminder. This video is for educational purposes only and is not financial advice. Markets carry risk. Always do your own research and consult a licensed financial advisor before making any trading decisions. Let's jump in. Let's start with what happened yesterday. Across the board, the data releases were low impact, so we didn't see any dramatic spikes. The New Zealand Business Services Index held steady around the 50.6 level, matching expectations, which kept the Kiwi relatively flat. New Zealand foreign direct investment also lingered near a modest 0.6% month-over-month, reinforcing a calm sentiment. In the UK, Rightmove's house price index stayed negative at roughly -1% month-over-month, echoing ongoing housing price pressure, but again without shaking the pound. Japan's preliminary GDP price index showed a slowdown from 3.4% year-over-year to a forecast level 2.3%, hinting at softer inflation, while quarterly GDP held at a 0.5% pace, both low-impact numbers that left the yen largely unchanged. Zooming in on the Kiwi, the Business NZ Services Index came in exactly where analysts expected, 50.6, and the impact rating was low. That tells us the services sector is neither surprising nor lagging, so traders didn't have a reason to adjust positions dramatically. When a key service indicator aligns with forecasts, the currency typically stays in a narrow range, which is what we observe for the NZD against its major peers. Over in Britain, Rightmove's house price index remained in negative territory at about -1% month-over-month, a figure that mirrors the ongoing correction in the UK property market. Because the impact rating was low, the pound didn't react strongly. The market is already pricing in a gradual easing of house price growth, so this data point simply reinforced the existing narrative rather than triggering a new trend. Turning to Japan, the preliminary GDP price index showed a slowdown to a forecast 2.3% year-over-year, down from 3.4% the prior period. Meanwhile, quarterly GDP held steady at 0.5%. Both figures carried a low-impact label, meaning the yen stayed mostly steady. The lower inflation readings suggest the Bank of Japan may keep its accommodative stance, which traders are already factoring into the currency's pricing. Moving to today's calendar, the first headline is Japan's revised industrial production for the month, forecast at 1.3% and matching the previous reading. Because the forecast aligns with the prior figure, the market will likely view this as a continuation of steady manufacturing growth. Traders keep an eye on industrial output as a proxy for domestic demand, and a consistent 1.3% rise suggests the economy is maintaining its current momentum without any surprise acceleration or slowdown. Next up is Japan's tertiary industry activity, which measures services sector performance. The forecast shows a contraction of 0.9% month-over-month, down from a previous 1.1% increase. While the impact rating is low, the shift from growth to contraction could hint at a softening in consumer-related services. If the actual data follows the forecast, it may reinforce a cautious tone among yen traders, especially those watching for any signs of broader demand weakness. Now let's shift to China. The fixed asset investment figure for the year-to-date is expected to be -6.2%, a slight deepening from the prior -5.7%. Fixed asset spending reflects long-term capital projects like infrastructure and real estate. A widening decline suggests that the pace of new construction and large-scale projects is slowing, a trend that analysts keep an eye on when assessing China's growth outlook and its impact on the yuan. Alongside that, foreign direct investment year-to-date is anticipated to stay around a -5% range, matching the previous -5.0% figure. When FDI remains negative, it signals that overseas investors are still cautious about committing new capital. While the impact rating is low, the persistence of outflows can weigh on sentiment toward the renminbi, especially as policymakers look for ways to attract more foreign money into the economy. China's overall industrial production for the year is forecast at 5%, a touch below the previous 5.3% reading. Though still solid growth, the slight deceleration could be a signal that the manufacturing engine is losing a bit of steam. Analysts often compare this number to the government's growth targets. A modest slowdown may prompt the People's Bank of China to keep a supportive policy stance, which in turn can influence the yuan's direction. A broader headline to keep on your radar: China delayed its July economic data release to late afternoon, a move that has traders watching the timing closely. The delay adds a layer of uncertainty about demand trends and the People's Bank of China's policy outlook. When data arrives later than expected, markets often experience a brief pause, followed by a quick reaction once the numbers hit, especially if they differ from consensus. This timing quirk could create short-term volatility in the CNY and risk-sensitive assets. To wrap up, yesterday's low-impact releases kept the major currencies in a tight range, while today's agenda offers a mix of steady Japanese data and slightly softer Chinese investment metrics. The yen may stay cautious amid mixed service activity, and the yuan could feel pressure if the delayed July numbers confirm slowdown. Remember, this is educational analysis, not trading advice. If you enjoyed the rundown, hit subscribe and ring the bell so you don't miss tomorrow's Tick to Loot update. Stay sharp, looters.